Hi dear. Welcome to Trader's Mind Code. 5 proven trading strategies that made me $100,000 in 6 months. Introduction. My journey from zero to $100K. Let me take you back to where it all began. In a fancy suit. No multi-monitor trading setup. No insider access or secret algorithm. Just one laptop, a shaky Wi-Fi connection, and a stubborn belief that I could figure this out. When I first stepped into trading, I had no financial background. I wasn't a math genius or some Wall Street insider. I was just someone searching for a way out of the 9 to 5 grind. Like most beginners, I was drawn in by stories of fast profits and flashy lifestyles. What I didn't realize then was that trading can be a brutal teacher. That I made nearly every mistake in the book. I chased hype. I over-leveraged. I ignored stop losses. I let my emotions dictate my decisions. And I paid the price. Over and over. It was humbling. Frustrating. Sometimes even depressing. But one night, after a string of losses, I sat in silence and asked myself a hard question. Am I really trading? Or am I just gambling with a fancier name? That question changed everything. That I decided that if I was going to make this work, I had to stop treating trading like a game of chance. I needed to treat it like a profession. That meant studying real strategies, tracking results, and following strict rules. Just like any serious business. I started over. I reviewed hundreds of trades, wins, losses, patterns. I stopped listening to internet noise and focused on what actually worked for me. I simplified everything down to 5 core trading strategies. These weren't based on guesses or gut feelings. They were built on rules, repeatability, and risk control. And then, things started to click. I stuck to those strategies. I managed my risk. I kept my emotions in check. And within 6 months, I turned a small trading account into over $100,000 in profit. Now, let me be clear, this isn't a promise. You won't become rich overnight. These strategies require discipline, patience, and practice. But what I can promise is this: these are real setups that worked for me. And if you apply them with focus and consistency, they can work for you too. This book isn't filled with fluff or theory. You're going to get real trades, clear setups, and the exact tools I used to grow fast while staying in control. Whether you're just starting out or stuck in a cycle of inconsistency, my goal is simple: to help you build confidence, structure, and results. Trading gave me freedom. And now, I want to show you how I earned it. One strategy at a time. Let's begin. Strategy 1. The power of breakout trading. Breakout trading was the first strategy that truly worked for me. It's simple. It's effective. And when executed correctly, it can lead to explosive moves in a very short amount of time. But here's the catch. Most people get it wrong. They chase fake breakouts, enter too late, or don't manage their risk. That's why I'm going to walk you through not just what breakout trading is, but how to do it right. Let's start with the basics. What is a breakout? A breakout happens when the price of an asset moves beyond a clearly defined level of support or resistance, usually with volume. It's like pressure building up inside a bottle. Eventually, that pressure needs to be released. And when it is, price can explode. A breakout can happen to the upside or downside. But in this strategy, I focus mainly on bullish breakouts, buying strength as price breaks above key resistance levels. Now let me be clear. A breakout is not just any move upward. We're looking for specific setups. We want to see a base, a consolidation zone, followed by a clean break through a ceiling that price has struggled to pass before. This is where the magic happens. My setup criteria. Here's what I look for in a textbook breakout. Tight consolidation. Price should be moving sideways within a well-defined range. The tighter the range, the better. This signals that buyers and sellers are in a tug-of-war, building pressure. Clear resistance level. This is the ceiling. Price must have touched this level multiple times without breaking it. That tells me it's a real barrier. And when price finally breaks it, it means something has changed. Rising volume on breakout. Volume is key. If price breaks resistance, but volume stays low, that's a red flag. I want to see strong volume as confirmation that buyers are stepping in with conviction. Minimal overhead supply. Ideally, there shouldn't be a lot of resistance immediately above the breakout level. If the path is clear, there's room to run. Positive market context. I always check the broader market. If the general trend is strong, it gives my breakout more fuel. Let me walk you through one of my real trades. A real trade example. Ticker XYZ. Entry $24.50 exit, $29.80 holding time. 3 days had been watching XYZ for weeks. The stock had formed a clean base between $22 and $24.50. Every time it approached $24.50, it pulled back until one Friday morning. Pre-market volume was already above average. The stock gapped up slightly and hovered around $24.30. I waited. I didn't jump in right away. When the market opened, volume surged, and price broke clean through $24.50. I entered the trade with a stop loss just under the breakout level, around $23.90. Why this setup worked? The base was tight and lasted over 2 weeks. $24.50 was tested 4 times before the breakout. Volume was 3x the daily average on the breakout candle. There was little resistance until $30.3 days later. After a strong run and signs of exhaustion, I closed the trade at $29.80 for a solid gain. Entry, stop loss, and exit. Here's how I structure every breakout trade. Entry. I enter as the breakout happens, not after a large green candle. If I miss the first push, I often wait for a retest of the breakout level. Stop loss, just below the breakout level or the base. That way, if the breakout fails, I'm out quickly with minimal loss. Exit. I use technical targets, prior resistance, measured move projections, or trailing stops if the move is strong. I never overstay. Common mistakes to avoid. Breakout trading is powerful, but risky if done wrong. Here are mistakes I had to learn the hard way. Chasing late, entering after the breakout is already extended increases risk. You want to be in as the breakout starts, not after it's run. Ignoring volume. Low volume breakouts often fail. Always wait for confirmation. No stop loss. Breakouts fail. It's part of the game. Never assume a breakout will work just because the chart looks good. Overtrading. Not every breakout is worth trading. Be selective. Quality over quantity. Why this strategy works. Breakouts are driven by psychology. A resistance level acts like a wall. Traders who shorted the top get squeezed when price breaks through. Buyers who waited on the sidelines now fear missing out. The result? Momentum, but the key is control. Discipline. When you combine technical structure with volume and market context, breakout trading becomes a powerful weapon in your arsenal. Strategy 2. Scalping like a pro. Quick wins. Quick exit. Scalping is the art of speed. It's about jumping in, grabbing a quick profit, and getting out, often within minutes, sometimes seconds. When I first discovered scalping, it felt chaotic. Fast charts, constant movement, split-second decisions. But with time, I realized that scalping isn't chaos. It's precision, it's structure, and when done right, it can be one of the most consistent strategies in trading. Let me explain how it works and how I used it to grow my account while limiting exposure to big losses. What is scalping? Scalping is a short-term trading strategy where you enter and exit positions within minutes, aiming to capture small price movements. Instead of trying to catch big trends, you're aiming for quick wins over and over again. The idea is simple: stack small, consistent profits. And more importantly, avoid large, risky trades. Most scalping happens on lower time frames, the 1 minute, 3 minute, or 5 minute chart. This isn't about holding overnight or even for a few hours. Your job is to spot a high probability setup, execute with speed, and move on. Why scalping works? Here's the edge. Scalping allows you to limit your exposure to market risk. You're not sitting in trades waiting for the market to go your way. You're in and out, focused only on clean setups with clear targets. Scalping works best in high volume, highly liquid markets, stocks, crypto, Forex, where price moves quickly and spreads are tight. This strategy taught me how to become more disciplined. Because in scalping, hesitation equals loss. My scalping setup over time. I developed a reliable structure for scalping. Here's what I look for before entering any trade. High volume asset. I only scalp assets with strong intraday volume. Without liquidity, entries and exits become sloppy. Pre-market or opening range breakout. I watch the first 15 to 30 minutes of the market. If a stock breaks its opening range with strong momentum, that's my trigger. VWAP as a guide. I use the VWAP, volume weighted average price, as a dynamic support or resistance level. If price is above VWAP with strength, I look for quick longs. If it's below, I consider short scalps. Tight spreads. This is non-negotiable. If the spread between bid and ask is wide, I skip the trade. Slippage kills scalping profits. Clean chart structure. I look for flags, micro pullbacks, or mini consolidations that break cleanly. Trade example. Crypto pair, BTC/USDT entry. $27,150 exit. $27,390 holding time. 6 minutes Bitcoin had bounced strongly overnight and was approaching a minor resistance zone. On the 1-minute chart, I saw a flag pattern forming just under the $27,150 level. Volume was increasing, price held above VWAP, and there was a micro pullback. I entered as price broke out of the flag. My target was modest, just a $200 move. I exited in under 6 minutes for a clean, fast gain. This trade had tight structure, clear breakout point, strong momentum, a predefined stop just under VWAP entry. Stop and exit rules entry. I buy the breakout of the flag or consolidation with volume confirmation. Stop loss, usually 0.3% to 0.5% below the entry, very tight. If the move fails quickly, I'm out even faster. Profit target. I aim for 1% to 2% gains, sometimes less. The key is fast execution and not overstaying that. I don't aim for home runs. I just want solid, repeatable singles. Tools I use for scalping 1-minute and 3-minute charts: VWAP and EMA, 9 or 20. Level 2 data for stocks. Volume spikes indicator, pre-market high/low lines. If I'm scalping crypto, I also use order book. Depth tools. Speed and clarity matter more than anything. Scalping rules to live by here are the golden rules that keep me consistent. Don't chase. If you miss the move, wait for the next setup. Entering late in scalping is a recipe for loss. Never hold and hope. If the trade turns against me, I cut it immediately. Hope has no place in scalping. Avoid overtrading. The goal isn't to take 20 trades a day. It's to take 2 or 3 high-quality setups and execute them well. Know the time of day. I focus most of my scalping during high volatility hours, the first and last hour of the session. Midday is often choppy. Size appropriately. With tight stops and quick moves, I can afford slightly larger position sizes, but I never over-leverage. Why I love this strategy: scalping helped me build confidence and consistency. It taught me the value of execution over prediction. Even on days when the market was unpredictable, I could still find small windows of opportunity. Over time, those windows added up and became a key part of my 6-figure success. Scalping isn't for everyone. It requires focus, speed, and emotional control. But if you can master those, it becomes a powerful tool in your trading arsenal. Strategy 3. Swing trading with volume confirmation. If scalping is a sprint, swing trading is a marathon at a steady pace. It's calm, calculated, and incredibly powerful when done with clarity and control. Swing trading was the strategy that gave me breathing room. The ability to let trades work over days, sometimes weeks, without the stress of minute-by-minute movements. And when I added one key ingredient, volume confirmation, my success rate improved dramatically. In this chapter, I'll show you how I used this strategy to capture meaningful trends, reduce noise, and grow my profits with far less screen time. What is swing trading? Swing trading involves holding positions for several days to a few weeks, aiming to capture a swing or a segment of a larger trend. You're not trying to catch the entire move, just the clean middle portion. That's where the money is. The beauty of swing trading is that it removes the need to time every tick. You're focused on broader market structure and clean setups, not noise. But even in this slower approach, timing still matters. And that's where volume confirmation comes into play. Why volume matters? Volume is a reflection of commitment. When a price move is backed by strong volume, it tells you that institutional money, the big players, are involved. That's what we want. Without volume, even a beautiful chart pattern can be a trap. That I use volume to confirm my entries. If price breaks out of a key level but volume is weak, I wait. If volume surges on a breakout, that's my green light. It's the difference between guessing and trading with confidence. My swing trading criteria. Here's how I filter trades with this strategy. Clear trend setup. I look for assets forming higher highs and higher lows. Classic uptrends. Alternatively, I'll trade reversals when a bottoming pattern forms. Chart patterns, flags, pennants, ascending triangles, or double bottoms. These are reliable structures I love to trade. Volume confirmation on breakout. This is non-negotiable. I want to see above average volume as the price breaks a resistance zone or completes a reversal. Multi-day support levels. My entries are based on breaks or bounces around strong support/resistance levels visible on the daily or 4-hour chart. Risk reward of at least 2:1. I don't enter unless I clearly see a reward that's twice the size of the risk. Real trade example. Stock. ABC entry. $51.20 exit. $58.90 holding time. 6 days the stock had been forming an ascending triangle. On the daily chart for 3 weeks. Resistance at $51 had been tested multiple times. I marked this level and waited. On day 21, the stock opened flat, but by midday it broke out above $51. Volume surged to twice the daily average. That was my signal. I entered at $51.20 with a stop at $48.80. Just below the pattern base. My target was $58, based on the height of the triangle pattern projected upward. 6 days later, after a strong upward move with continued high volume, I exited at $58.90. Entry, stop, and exit strategy. Entry. I enter as price breaks out of the pattern. On strong daily volume, I prefer entering near the end of the day if the breakout holds. This avoids fake intraday moves. Stop loss. Just below the most recent swing low or pattern support. Exit. I use measured moves based on the pattern, like the triangle height. Prior resistance levels or trailing stops to lock in gains. Tools I use daily and 4-hour charts. Volume indicators, relative volume or OBV. Moving averages, 20 MA. 50 SMA, trendline drawing tools RSI, and MACD, for confirmation only. These tools help me spot trends, confirm strength, and stay out of low-quality trades. Avoiding common mistakes. Swing trading looks easier than it is. Many traders fall into traps that hurt their consistency. Here are the biggest mistakes to avoid. Entering before the breakout. Anticipating the breakout can lead to early losses. I wait for confirmation, the break, and the volume. Ignoring the bigger picture. Trading against the market trend often leads to failure. I always check the broader trend. Is the index bullish? Is the sector strong? Setting tight stop. Swings involve pullbacks. A stop too close to entry will get hit. I give trades room to breathe, but size down to manage risk. Holding through news events. I avoid holding trades through earnings or major economic announcements unless I'm already deep in profit. Why this strategy works. Swing trading with volume confirmation works because it combines 2 critical truths. Structure gives you direction. Volume gives you conviction. You read trading with the market, with the trend, and with real money behind the move. And the best part? You don't have to watch the screen all day. You can scan the market in the evening, plan your trades, and let them work while you go about your life. It brings balance, something most traders don't talk about enough. This strategy played a huge role in my 6-figure journey. While scalping brought quick gains, swing trading delivered consistent compounding over weeks. That's how accounts grow fast, with momentum and patience. Strategy 4. The news catalyst setup. Ride the momentum. Sometimes all it takes is one headline. A breakthrough earnings report, a product launch, a regulatory change, a celebrity tweet. Suddenly, a stock or crypto pair explodes. Volume surges. Volatility spikes, and traders scramble to react. That's what we call a news catalyst, a real-time event that triggers massive market movement. Most traders fear this chaos. I've learned to embrace it and capitalize on it. In this chapter, I'll show you how I use the news catalyst setup to enter trades at the right moment, ride the surge, and exit with profits, all while controlling risk in fast-moving conditions. What is a news catalyst? A news catalyst is any event or announcement that causes an immediate and significant price reaction. This includes earnings reports, economic data, like inflation or jobs reports, company press releases, regulatory announcements, mergers or acquisitions, product launches, influencer or media mentions, sudden sector-wide movements. These events introduce urgency to the market. They force participants to make decisions quickly. That's when emotion takes over, and momentum builds fast. That if you can recognize the pattern early and enter strategically, these catalysts can produce some of the biggest single-day gains you'll ever see. Why it works, the news itself doesn't matter as much as the reaction to it. In other words, it's not about whether the news is good or bad. It's about how the market responds. If price surges on high volume and breaks key levels, I don't waste time trying to interpret the news. I trade the chart. This strategy works because of herd psychology. When momentum kicks in, retail traders chase. Short sellers panic. Algorithms accelerate moves. You don't need to predict anything. You just need to ride the wave while it's building. My catalyst setup checklist. Here's what I look for before entering a trade on a news event. Fresh catalyst within the last 24 hours. I only trade events that are new, not something that's been priced in for days. The newer the news, the stronger the reaction. Strong price reaction with high volume if price explodes through resistance on 2-3x average volume. That's my green light. Clean intraday structure. I look for flags, pennants, or small consolidations that form after the first news-driven move. These are ideal entry points. No immediate resistance overhead. I avoid entering if price is heading straight into a brick wall of prior resistance. Confirmation from market sentiment. Is the broader market bullish? Is the sector also moving? These add momentum fuel. Real trade example. Ticker XZY News. FDA approval entry. $9.20 exit. $12.85 holding time. 3 hours at 9:03 a.m. News dropped that a small biotech company received FDA approval for its cancer treatment. The stock immediately jumped in pre-market from $6 to $8.90. At the open, it surged past $9 on volume 5x the average. I didn't chase the first candle. I waited for a 5-minute flag to form, a tight range just under $9.20. Once it broke out with a fresh volume spike, I entered at $9.20. I scaled out gradually as price moved upward and closed the position at $12.85 before the momentum slowed. I didn't need to understand the full science behind the approval. I traded the reaction, not the reason. Entry, stop, and exit entry on the breakout of a clean pattern after the news is released and volume confirms. I rarely enter the very first spike. Stop loss, just below the consolidation or pattern low. News catalysts are volatile. I accept slightly wider stops, but use smaller position sizes. Exit. I use prior resistance levels, psychological round numbers, or a trailing stop based on a moving average. I never try to ride it to the moon. Tools I use: News Scanner, Benzinga, Twitter, TradingView alerts, 5-minute chart for structure volume bars, and VWAP pre-market high/low lines breakout alert indicators. Optional. Speed matters here. The faster I identify a clean pattern after the news, the better my entry. Common pitfalls to avoid: news catalyst trading is powerful, but dangerous if approached carelessly. Here's what to avoid. Chasing the first spike. The first move is often unsustainable. Wait for a pullback or consolidation. Ignoring the chart. Not all news is trade-worthy. If the chart is ugly, the news doesn't matter. Oversizing volatility is extreme after a catalyst. I reduce position size to stay calm and clear-headed. Holding too long news-driven moves can reverse quickly. I lock profits early and don't get greedy. Getting emotionally involved, whether the news is exciting or dramatic, I stay focused on price action only. Why this strategy was a game-changer: news catalysts were responsible for some of my biggest single-day profits. But more importantly, they taught me how to act under pressure. Fast decisions, fast execution, and fast exits. Unlike swing trades that evolve over days, catalysts reward decisive traders. And once I had this strategy dialed in, I started to recognize the same patterns again and again: breakouts, flags, volume surges, and price levels being respected. When you stop reacting to headlines and start reacting to price, the game changes. Strategy 5. The high-risk, high-reward pattern. Only when the odds are right. This is the strategy one use the least. But when I do use it, it has the potential to deliver some of the biggest wins in my trading career. That I call it the high-risk, high-reward pattern. That it's not a setup I chase every day. In fact, I sometimes go weeks without taking a trade like this. But when the right conditions align, this strategy becomes a weapon, powerful, aggressive, and capable of delivering massive returns in a single move. But let me be very clear. This pattern is not for reckless gamblers. It requires patience, discipline, and experience. It's high risk, and unless the odds are heavily in my favor, I don't touch it. Let me explain exactly how I approach it and why it's played a key role in my six-figure growth. The setup. What makes this trade different? Most of the strategies I've shared so far, breakouts, scalping, swing trading, are built on structure, repetition, and controlled conditions. This one is different. This strategy is built around compression, mispricing, and extreme positioning. Here's what I look for: an asset that has been beaten down over weeks or months. Heavy short interest. The market is aggressively betting against it. A key technical level or psychological price zone being tested. And then a sudden trigger. News, volume spike, or anomaly that flips the script. This trade plays on one thing: pressure release. When too many traders are positioned one way, especially short, and something breaks the pattern, the result is violent and rapid movement. This is where I step in. Real example. Stock. Elements setup. Massive short squeeze entry. $3.40 exit. $9.10 holding time. 2 days element had been trending down for 3 months. It was sitting near $2.80 with massive short interest, over 35% of the float. Retail traders had given up. Nobody wanted it. Then, out of nowhere, a press release hit. The company announced a major partnership with a tech giant. In the same hour, volume exploded. I didn't buy the initial spike. I waited. On the 1-hour chart, a clean consolidation formed around $3.30 to $3.40. The volume was still climbing. Social sentiment was going crazy. Shorts were clearly trapped. I entered at $3.40 as it broke consolidation, with a stop at $2.80. I knew the risk, but the upside was clear. My target was $6, but the move went further. Within 48 hours, it hit $9.10. I sold in stages on the way up. High risk? Yes, but calculated, controlled, intentional. Entry criteria to be eligible for this strategy. All 5 of the following must be true. Heavy short interest or extreme sentiment. I look for short interest above 25% of float, or an overwhelming bearish bias in the market. Extended downtrend or range compression. The asset must be in a long-term decline or a tight, narrow range. This builds the spring. Clear technical level price must be pressing against a key level that shorts are defending. A breakdown line, a psychological round number, or a multi-month resistance. Catalyst or trigger event. This could be unexpected news, a sudden volume burst, or a technical breakout on multiple time frames. Volume surge. The move must be confirmed by a significant increase in volume, 2x or more than average. Only when these 5 factors align, I even consider entering. How I trade at entry. After the initial spike, I wait for the first pullback or consolidation and enter on the breakout, not during the chaos. Stop loss. Below the consolidation zone or recent swing low. This keeps risk defined. Position size, smaller than normal. Since the move is volatile, I scale down to protect capital. Exit plan. I scale out in stages. First target at a 2-to-1 ratio. Second at 3-to-1 or more. If the move turns parabolic, I use a trailing stop to capture the rest. Key risk factors to manage. Let's be honest. This setup carries real danger if handled carelessly. Here are the mistakes I've learned to avoid. FOMO entry. Never enter during the initial spike. That's where people get trapped. I wait for structure. No catalyst. If there's no reason for the move, it's just noise. I only trade when there's a reason behind the momentum. Oversizing. This strategy tempts traders to go big. That's a mistake. I reduce size to handle the volatility. Holding too long. These moves are fast, but they fade just as fast. I don't marry the trade. I take the gain and move on. Emotional bias. These setups get noisy. Fast-moving charts, social media hype, wild predictions. I stay grounded and stick to my plan. Why this strategy matters. This isn't my go-to. This isn't my everyday trade. But when the setup is right, this strategy has delivered some of my largest percentage gains. It works because it flips the psychological script. When short sellers are squeezed, panic takes over. And panic creates opportunity. For the prepared, This pattern reminds me that the market rewards boldness with preparation, not blind risk, but smart, calculated aggression when the odds are heavily in your favor. Risk management rules that save my capital. If you forget everything else in this book, remember this. Risk management is the reason I kept my profits. It's the reason I didn't blow up my account when a trade went wrong. And it's the reason I was able to grow fast without gambling. No trading strategy, no matter how powerful, can survive poor risk control. In fact, most traders who fail don't lose because their setups are bad. They lose because they don't manage their losses. Let me walk you through the exact risk management rules that protected my capital and ultimately made my $100,000 journey possible. Rule number 1. Never risk more than 1 to 2% of your account on a single trade. This is the golden rule. Before every trade, I calculated the dollar amount I was willing to lose. That number was never more than 2% of my total account. Most of the time, it was closer to 1%. If I had a $10,000 account, my maximum risk per trade was $100 to $200. That meant if I took a loss, I'd still have 98 to 99% of my capital intact. This one principle saved me from large, emotional losses. It turned trading from a game of survival into a game of controlled opportunity. Rule number 2. Use stop losses. Always. I never traded without a stop. Every trade had a hard stop, a price level where I'd automatically exit if the market moved against me. Not a mental stop. Not a let's see if it comes back plan. A real stop. Preset. Non-negotiable. Stops remove emotion. They protect you from catastrophic loss. And they force you to define risk before you enter the trade. That if a setup doesn't allow for a reasonable stop and still meet my risk limits, I don't take it. Simple. Rule number 3. Plan the trade. Then trade the plan before I entered any position. I wrote down 3 things: my entry price, my stop loss, my profit target. Once the trade started, I followed the plan. No improvising, no second guessing, no shifting stops out of hope. Discipline turns randomness into structure. When I became strict with my process, my results stabilized almost immediately. Rule number 4. Position sizing is more important than entry. Most traders obsess over finding the perfect entry. I used to do the same. But the truth is, you can be slightly off on entry and still succeed if your position size is right. Too large, and even a small move against you can trigger panic. Too small, and even good trades won't make a difference. That I sized every trade based on the distance to my stop loss. That way, I could risk the same amount of money, whether I was taking a tight scalp or a wide-range swing. Here's the formula I used. Position size equals account risk dollar divided by entry price, stop price. It's simple math, and it works. Rule number 5. Accept that losses are part of the game. This was one of the hardest lessons to learn, but the most freeing. Losses aren't failures. They're fees. Think of trading like running a business. Every business has operating costs. In trading, losses are your cost of doing business. The key is to keep those costs small and predictable. I stopped fighting losses. Instead, I focused on making sure they didn't get out of hand. And I never let one loss turn into 2 or 3 because of frustration. Rule number 6. No revenge trading. Revenge trading is emotional trading. It's dangerous, and it's responsible for some of the biggest account blowups in history. If I lost a trade, I'd take a breath. I'd walk away, even for a few minutes. I'd reset. Sometimes, I'd stop trading for the day entirely. The goal is not to make your money back on the next trade. The goal is to stay in the game long enough for your edge to play out over time. Rule number 7. Daily max loss limit before each day. I set a personal rule. If I lost more than 3% of my account, I was done for the day. No exceptions. This rule stopped me from spiraling on bad days. It preserved my capital and protected my mental state. The best traders in the world still have losing days. The difference is they don't let one bad day ruin a week, a month, or a career. Rule number 8. Risk management is boring. And that's the point. Let's be honest. Risk management isn't exciting. There's no dopamine rush in calculating stop losses or reducing size. But it's the foundation everything else is built on. If you skip this step, your strategies, no matter how good, will eventually fail. If you embrace it, your account becomes something few traders ever experience: stable, growing, and sustainable. Final thoughts on risk. In the early days, I used to think the key to success was finding the perfect trade. Now I know. The key was learning how to survive the imperfect ones. Trading is about managing uncertainty. You will never have full control over the market, but you always have control over your own risk. That's the difference between professionals and everyone else. Professionals protect their capital like their lives depend on it. Because in this business, they do. In the next chapter, we'll go even deeper into the psychology behind my trades. Because risk management is only half the battle. The other half is your mind, and mastering it is what separates consistent winners from emotional wreckage. Let's move on. The psychology behind my trades: you can master every chart pattern. You can memorize every indicator. You can backtest strategies until your screen goes dark, but if you can't manage your emotions, if you can't stay calm when the market turns, if you can't take a loss without losing your mind, then none of it matters. In this chapter, I want to pull back the curtain, not on the charts, but on what was happening in my head. Because my journey to $100,000 wasn't just technical. It was deeply psychological. This is the side of trading most people avoid. But this is where the real battle is won. The hard truth. The market is a mirror. Trading exposed every flaw in my mindset. It showed me how impatient I was, how quickly I got greedy, how badly I feared being wrong. The market has a way of reflecting your inner world right back at you. If you're impulsive, it punishes you. If you're emotional, it teases you. If you seek revenge, it humbles you. I had to confront this, not once, but every single day. And I had to rewire the way I thought. Let's talk about how I did that. Lesson 1. I had to stop needing to be right in the beginning. I equated being right with being successful. I thought a losing trade meant I was failing. So I'd avoid taking the stop loss. I'd hold, hoping to prove myself right. And most of the time, it ended badly. Eventually, I had to accept a truth I now live by. Trading is not about being right. It's about being profitable. That single mindset shift changed everything. I started thinking like a casino. They don't care about any single bet. They care about their long-term edge. And because they manage risk and play the probabilities, they always come out ahead. That became my goal, not to win every time, but to win over time. Lesson 2. I let go of the outcome. Every time I placed a trade with emotional attachment, I lost if I needed the trade to work. If I was thinking about what I'd buy with the profits, if I tied my confidence to the result, I was setting myself up for failure. I learned to let go. Once I entered a trade, my only job was to follow my rules. The outcome was out of my hands. Win or lose, my process was my anchor. This gave me mental freedom, and strangely enough, once I stopped needing every trade to work, my win rate actually improved. Lesson 3. I created psychological rituals. Trading is 90% routine, 10% execution. Before each trading session, I developed rituals to get my mind right. I reviewed my trading plan. I revisited my past mistakes, not to dwell, but to remind myself what not to repeat. I took a few deep breaths before clicking anything. These tiny rituals helped me enter each session grounded, focused, and emotionally neutral. The market is unpredictable, but my state of mind didn't have to be. Lesson 4. I got comfortable with boredom. This one might surprise you. The most profitable trading days I've had were also the most boring. No excitement, no rush, just structure, clarity, patience. You see, real trading success doesn't feel like a casino win. It feels quiet, simple, controlled. Once I stopped chasing adrenaline and started appreciating boredom, my consistency soared. Boredom is the space where discipline lives. Lesson 5. I built emotional recovery systems after a losing trade, especially a painful one. The temptation to get it back was always there. That's where most traders spiral. I needed a system to recover emotionally. Here's what I did. I took breaks, real breaks. I stepped away from the screen. I journaled what happened, what I did well, what I could improve. I reminded myself, one trade does not define me. Over time, these habits turned my emotional lows into lessons, not liabilities. Lesson 6. I protected my confidence. Confidence is fragile in trading. One bad day can shatter it. One streak of losses can make you doubt everything. I built my confidence on things I could control. Following my rules, executing my stop losses, taking only high-quality setups, staying consistent, even on tough days. Stopped measuring success by profit alone. I started measuring it by discipline. And discipline builds confidence that lasts. The takeaway: Mindset is the foundation. Every winning trade I made was born from clarity. Every disciplined exit was the result of mental preparation. Every profitable week was powered by the same things: focus, patience, and self-control. Technical skills are important, but mindset is the glue that holds everything together when the market gets messy. And trust me, it always gets messy. In the next chapter, I'll walk you through the lessons I learned along the way, not just from my wins, but from the trades that hurt, the missteps, the missed opportunities, and what I'd do differently if I were starting again today. Because success isn't just about what you do right. It's about what you learn when things go wrong. Let's continue. Lessons learned. What I do differently. Looking back on my journey from zero to $100,000, I see the path clearly, but I also see where I stumbled, where I wasted time, where emotions clouded judgment, and where better decisions could have accelerated my progress. No trader is perfect, no strategy is flawless, and no journey is without lessons. In this chapter, I want to share the key lessons I learned, the insights that only come from experience, and what I would do differently if I were starting today. My hope is that by learning from my mistakes, you can shorten your path to success and avoid the pitfalls that nearly cost me everything. Lesson 1. Start small. Focus on consistency over size. Early on, I chased big wins. I risked too much on single trades, hoping to make it big fast. That mentality almost blew my account. If I could rewind, I'd start smaller, maybe risking only 0.5% per trade. I'd focus on building consistency and confidence rather than size. Because compounding small wins is far more powerful than chasing rare home runs. Big wins come naturally once you master the basics and keep your capital intact. Lesson 2. Develop a clear, written trading plan and follow it. I used to trade impulsively, reacting to whatever felt right in the moment. No plan, no process, no structure. That changed everything when I started writing down my rules. Entry criteria, stop-loss levels, profit targets, and risk limits. If I were starting again, I'd build my plan first and treat it like a contract with myself. That way I'd avoid emotional, undisciplined trades that cost me money and confidence. Lesson 3. Prioritize risk management from day one. Risk management was a hard lesson. I learned it the expensive way. Looking back, I wish I'd accepted from the start that protecting my capital was the #1 priority. If I could start over, I'd never skip setting stop losses, and I'd never risk more than 1% per trade, even if it meant missing perfect setups. When you preserve capital, you buy yourself time, and time is the greatest edge in trading. Lesson 4. Master one strategy before expanding. I was tempted to try every strategy one read about. Scalping, swing trading, news catalysts, options, futures. I jumped in head first. That scattered my focus and slowed my progress. If I had a do-over, I'd pick one strategy, the one that suits my personality and lifestyle, and master it completely before adding anything else. Depth beats breadth in trading. Mastery over many half-learned strategies. Lesson 5. Build emotional resilience early. The emotional roller coaster nearly derailed me. I wasted too much energy reacting to losses, doubting myself, and chasing wins. If I were starting today, I'd put mental training front and center: journaling, meditation, breathing exercises, and rituals to build calm focus. Trading isn't just about charts, it's about managing your mind. Lesson 6. Embrace boredom and patience. Early in my journey, I chased excitement, the thrill of fast profits, big moves, and adrenaline spikes. But most profitable trades are quiet and patient. They require waiting for the right moment. Even if it's boring. If I started over, I'd embrace boredom as part of the process, the necessary space where discipline grows. Lesson 7. Use technology to your advantage, but don't depend on it. I learned a lot from scanners, alerts, and algorithmic tools. But I also nearly became a slave to notifications and endless screen time. If I could start fresh, I'd set up smart alerts to catch high-quality setups, but avoid information overload. I'd use technology as a tool, not a crutch. Lesson 8. Keep a detailed trading journal from day one. I started journaling late, after losing more than I care to admit. A trading journal is your best teacher. It reveals patterns, mistakes, and strengths you can't see in the moment. If I began again, I'd journal every trade, entry, exit, emotion, and lesson, without exception. Lesson 9. Avoid overtrading. Quality over quantity. In the early days, I thought more trades meant more profits. It didn't. Overtrading led to exhaustion, poor decisions, and losses. If I could do it over, I'd be more selective, waiting patiently for the best setups and avoiding noise-driven trades. Lesson 10. Never stop learning, but filter your sources. The trading world is full of noise, hype, and conflicting advice. I wasted time chasing the latest secret or following every guru. If I started again, I'd commit to continuous learning, but from a few trusted, proven sources. I'd test ideas carefully with my own money and data. Final thoughts. None of these lessons were easy to learn. Many came at a cost, financial and emotional, but they made me a better trader, a disciplined trader, a trader who went from zero to $100,000 in 6 months. If I could give you one piece of advice, it's this: be patient, be disciplined, protect your capital, learn from every mistake, and never stop improving. Your journey will have ups and downs. That's part of the game. But with the right mindset and these lessons in hand, you can reach your goals faster and with less pain than I did. In the next chapter, we'll wrap up the book with final thoughts and a clear action plan you can start implementing immediately. Ready to finish strong. Final chapter: how you can start your own 6-month trading plan. Congratulations on reaching the final chapter. By now, you've learned my 5 proven trading strategies, the critical risk management rules, the mindset shifts that made the difference, and the lessons I wish I'd known from the start. But knowledge alone isn't enough. The real transformation happens when you take action, when you build your own personalized trading plan and commit to executing it consistently over time. In this chapter, I'll walk you step by step through how to create and start your own 6-month trading plan, the exact blueprint that can set you on the path to reaching your first $100,000 in trading profits. Step 1. Set clear, realistic goals. Begin with clarity about what you want to achieve. What is your financial target for the next 6 months? How much capital are you starting with? How many hours per day or week can you realistically dedicate to trading? What is your risk tolerance? Write down your goals. Make them specific, measurable, and achievable. For example, I want to grow my $10,000 trading account to $50,000 in 6 months by risking no more than 1.5% per trade and trading no more than 2 hours daily. Having clear goals keeps you focused and accountable. Step 2. Choose your primary trading strategy from the strategies in this book. Pick one that suits your personality, time availability, and risk appetite. If you like fast-paced, frequent trades, consider scalping. If you prefer a balanced approach with less screen time, swing trading with volume confirmation is ideal. If you thrive under pressure and can handle volatility, the news catalyst setup might be for you. The high-risk, high-reward pattern is best for experienced traders who can handle bigger swings. Master one strategy first. Learn it deeply before exploring others. Step 3. Develop a written trading plan. Your plan should include entry criteria. What conditions must be met before you enter a trade? Exit criteria. When do you take profits or cut losses? Risk management. How much will you risk per trade? What are your stop-loss rules? Tools and indicators. Which charts, time frames, and indicators will you use? Trading schedule. When will you trade and for how long? Writing your plan creates discipline. It removes guesswork and emotional decisions. Step 4. Create a routine and stick to it. Consistency is the secret to success. Set a daily or weekly routine that includes market analysis and scanning for setups, reviewing your trading plan and goals, journaling your trades and emotions, taking breaks to maintain mental clarity. Treat trading like a professional job, not a hobby. Step 5. Implement risk management without compromise. Risk management isn't optional. It's your foundation. Commit to risking no more than 1 to 2% of your account on any trade. Always use stop losses. Calculate position sizes carefully. This discipline will protect your capital and allow you to stay in the game long enough to succeed. Step 6. Keep a detailed trading journal. Record every trade, entry, and exit points. Reason for taking the trade: profit or loss, emotional state before, during, and after the trade, lessons learned. Review your journal weekly. It's your most valuable tool for continuous improvement. Step 7. Review and adjust monthly. Every month, step back and evaluate your progress. Are you meeting your goals? Which trades worked well? Where did you make mistakes? Is your strategy still a good fit? What adjustments can improve your performance? Trading is a dynamic skill. Your plan should evolve as you grow. Step 8. Build your mindset and emotional strength. Trading success is built on mental strength. Practice patience, discipline, and emotional control. Develop rituals to manage stress and stay focused. Remember, every trader faces losses. What matters is how you respond. Step 9. Stay educated but avoid overload. Keep learning, but don't overwhelm yourself with endless strategies or news. Focus on mastering your chosen strategy and risk rules. Filter your information sources. Quality beats quantity. Step 10. Take action and commit. A plan is only as good as your execution. Start small, stay disciplined, and commit to your 6-month journey. There will be ups and downs. That's part of trading. But with focus, patience, and consistent effort, you can reach your goals. Closing thoughts. The journey to $100,000 in trading profits isn't easy. It requires hard work, discipline, and a willingness to learn from every trade. But it's absolutely achievable, especially with a clear plan and the right mindset. You have the knowledge now. You have the strategies. You have the risk rules and mindset tools. Now, it's time to take control of your trading journey. Create your plan. Execute with discipline. Learn and adapt. Your future self will thank you.